Okay, hey, good morning, everyone. Welcome to today's macro snapshot. We are, what are we? Tuesday, January the 14th, 2025. Let's immediately get into it. Just want to start off, guys, just have a quick look and see what's happening here. I was just looking at the volatility chart. So we see volatility has actually come down a little bit here. We see on the VIX, it was up, it got up to about 21 or so. But as we speak this morning, a slightly better sort of mood for the equities at about 18 and a half. So normally, as we know, as vol comes down in the volatility service, that should be a sort of a slight positive for the equities. And if we just look at the actual curve, you can also see that reflected in the VIX futures. So we see here that still a little bit of concern, but basically, if you look compared to 1 day ago, you can see the VIX curve or the prices have come down. So this sort of purple one is where we were 1 day ago. So you see that all across the VIX futures curve, the sort of the prices coming down. And normally what you want to see in a sort of a relatively contained market, of course, is like a sort of a contango kind of situation where there's not a huge amount of volatility at the front and the curve prices volatility further out. What you don't want to see, or what is a sign of increasing stress in the market, of course, is a curve which has flipped into backwardation. So we still do have that a little bit, because if we look, let's say, from a week ago, you can see here, so a week ago, you can see here, this is the curve in yellow. You can see that the spot price here, so this is the spot, and then each dot represents 1 month into the future. You can see the spot price here, it's clearly the curve is in contango. So the least amount of sort of volatility stress priced into the market is at the front of the curve, which is the most supportive thing you want to see for equities. But what we can see, of course, is that over the last week, the very front of the curve, so the spot has flipped up, as well as the actual level itself. But what we're seeing now is that if we take off we'll take off the weekly and we'll take off a day ago, we can see that it's actually come down a little bit. So VIX has come down a little bit. We obviously have PPI today, which is going to be important, and then even probably more important, the CPI tomorrow. So as long as that VIX keeps down, sort of sub 18, 17, 19, not too bad for equities. But as soon as we get over the 20, 20 and a half, 21 level, that will cause a little bit of pressure on equities. Because as you know, a lot of vol targeting firms, they actually reduce their exposure as volatility rises. So let's keep an eye on the curve. Okay, so let's just have a quick look before we get into, well, actually, let's get straight into the PPI. So we know that the Fed is very focused at the moment on sort of inflation, and the market is a little concerned that inflation has remained sticky. And what we can see, just quickly having a look, is that the market is essentially priced in 2025 only one cut. So we go all the way out to the end of 2025. So the first cut here is not until the Fed meets at the very end of October, or almost beginning of November. So essentially 10, 11 months away. And we just have one cut here priced. That's the number of cuts priced. So pretty incredible. As I think I mentioned yesterday, we had up to 10 cuts priced for 2025 as recently as 3 or 4 months ago. So a very hawkish sort of repricing. And really the question I'm trying to figure out my own head is, is that too hawkish? Of course, if we get hot PPI, CPI numbers, inflationary policies potentially from Trump, or Trump's policies, which potentially could cause inflation, and we have to distinguish between, hypotheticals and what actually happens, and, very sort of warm and strong real economic data. What's going to be interesting is that maybe even this one cut, you see here 25 basis points, could even be completely taken out, priced out of the market for 2025, and maybe pushed into the latter half of 2026. So that's really what the market is thinking about. But let's just turn our attention to PPI. One thing I just would quickly say, guys, we had the small business survey, National Federation of, I think, Independent Businesses, which historically has been quite a good foretaste, precursor, forerunner of what happens in the real economy, because these are smaller companies. I mean, they're not tiny mum and pop shops, but definitely not, sort of Apple or something like that. So, and what we can see this morning is that the sentiment here is a survey, pretty strong, 105 compared to 102 expected, and the prior of 101. So the point is that as we have the inauguration of Trump next Monday, I believe it is. Definitely the small business cohort or community is feeling good. Let's just put it that way. So, uh, people talking about, stocks coming off and the real economy and everything. The reality is that, the business community is relatively bullish at this point. We'll just put that out there. So in terms of the PPI, what I would say is that we're expecting a relatively sort of warm number. So let's just have a look at the headline number here, 0.4, the same as now. If you annualize that, of course, that's 4.8, which is high. But once we get into the core numbers, so excluding food and energy, that's probably the most important one, 0.3, the final demand. But the point is that one's meant to be a bit higher than, well, consensus is higher than last time, which was 0.2. We also see that excluding food, energy, and trade, 0.3 rather than 0.1. So the overall picture here is that the market is expecting a relatively warm number. So the consensus definitely is for an inline number. And what I would basically say, as we just saw, is that the market has substantially repriced expectations for the Fed in a hawkish direction over the last few months. So we're getting to a point where, for example, the front end of the curve, it could still go up a little bit more in terms of yields. But we've got to the point now where there's only one one cut priced in for 2025 at this point. And really, the bar for the Fed to hike, would have to say, is very, very high. That would represent for the Fed a big U-turn symbolically, psychologically. They won't want to do that and admit a mistake. And of course, the incoming president in the White House will be very unhappy about any rate hikes. So my base case here is that in order for the Fed to hike, which some commentators have talked about, I think that is, sure, everything's possible, but we're quite far away from that. So therefore, what I'm saying is that even if the PPI comes in a little bit warmish, we're starting to get to the point with the data that there's not a huge amount more than can be repriced hawkishly at the front end of the curve. And we'll look at the charts in a second. So maybe the thing is that, we're getting to the point where any sort of pressure in terms of hot inflation data or, strong real economy data the pressure starts to go more to further out the curve. So at least like from the 5, we've seen the 5 has been underperforming everywhere on the curve and even out to the 10 and the 30. But especially that sort of 5, 7, 10-year belly of the curve, it looks like the one which is going to take any pain in terms of higher inflation and stronger real economy data. A good cup of English breakfast tea. Okay, so let's have a look and see what's happening here. So I do believe if the number comes in a little bit comes in line, that's probably like 60, 70, 80% chance. That's probably really what's going to happen here. I think what we could get is a small relief rally, just the fact that it's not higher than expectations. So relief rally for me at the front end of the curve means that the yields might go down, not a huge amount, maybe 2, 3, 4 basis points. And all across the curve, we could see the yields going down a little bit also at the back end, but not a huge amount. I believe that stocks as well could have a slight relief rally on that. So what happens if we get a soft number? I think it's going to be the same as an inline number. So a soft number here could be, let's say 0.3, a couple of these numbers, maybe a tenth lower than expectations. I believe the stocks will rally probably a little bit further than in an inline number, of course, maybe up 20, 30, 40 points, something like that. And then the yields down again, rather than 2 or 3 basis points, maybe 3, 4, 5 basis points, the yields could come down. What I think really would get the market's attention, and I'm not saying anything complicated here, is a hot number. So let's say we get headline at, 0.5, and some of these other numbers here are 10th higher than expected. I think there you could see the 2-year yield pushing even up. It does have a little bit more scope to go because, as I said, there's still one cut priced in for 2025 this year. So in theory, the market could start to take away even the chances of one cut. So there's still potentially 15, 20 basis points on the 2-year, which it still could go up, and that could go up to even something like 4.55. We'll look on the charts in a little bit, and maybe in the 30-year up to maybe up to 5.05, something like that. And what we could see is on the butterfly, we could see the 2s, 5s, 30s. We could see that the 5-year underperforms, so the yield would go up more than the 2s and the 30s. So that's interesting. So maybe sort of long 2s, long 30s, and shorting the 5. So let's look at a couple of charts here and just see actually what's going on. The other thing as well, just keep in mind today, guys, just while we've got the terminal open here, is is we have a couple of Fed speakers. So we have, who do we have? We have Williams and Schmidt speaking. So Williams always pretty important because I think, has the ear of Fed Chair Powell. Also, of course, he's the head of the New York Fed. So let's see if he has anything to say, after the data. Just give us any kind of insights there. Oh yeah, oil. Okay, so let's just have a quick look and look at some of these charts. Right. So we looked at volatility. As I say, volatility has come down a little bit, but still not at low levels, completely low levels here. Okay. So just in terms of we'll look at the SPX here. Having a little bit of a bounce. Now, again, as I say, if we get an inline number or even a slightly soft number, I do believe there's more potential to bounce because overnight we had a report which is, not particularly confirmed and certainly not agreed to or confirmed by Trump himself, that Trump's team, the incoming team, is exploring, rather than starting the day, his inauguration day on the 20th with 20 or 25% tariffs across the board, is considering bringing in graduated tariffs. So let's say every month, putting between 2 and 5% on, let's say, Mexico, Canada, China, and Europe. So rather than just coming in on day one and saying, boom, 20, 25% on everyone, it could be a graduated step up kind of process. And the market quite liked that. We saw there was a little bit of relief in the bonds. And also, as you see here, in some of the risk assets, for example, SPY, we also look at, for example, we look at NASDAQ up just a little bit. But that was counterbalanced because the Premier of Alberta, the Canadian province, she actually spoke with Trump over the weekend, I think at Mar-a-Lago down in Florida. And she made a statement yesterday overnight, or maybe late afternoon, essentially saying that she saw nothing to counteract the idea that Trump would not come in on day one in terms of Canada and put in to 20%, 25% tariffs. So the point is, her perception is a little bit at odds with that other report saying, Trump might be a bit more gradual. So I think we still have to open ourselves to the possibility that Trump may want to go big and go hard on day one. And, potentially some markets are underpricing that. And of course, what we saw then, in just getting back to Canada, in the Canadian oil space, a lot of Canadian oil producers, they sold off quite a lot with this idea that, Trump would not exclude oil. Because remember that about 40% of oil used for crude refinery in the US actually comes down from Canada. So there's potential that price would go up, which is potentially not great for Canadian oil producers, for those of you interested in that kind of stuff. So the point is that the tariffs are still potentially alive and well, but the market did like what it heard out of the fact that maybe tariffs could be introduced 1 or 2% per month. So that's that. Okay, the other thing you just want to look at here, oil's has been doing pretty well. So let's have a look at the oil complex here. Where are we? So a few things happening in oil. So oil, as you guys can see, it had been ranging, as we all know, for 3 or 4 months, broke out of this down pattern. Now at a pretty key level here, facing a first bit of resistance. But it's a strong chart. And if we actually look at some of the time spreads, which I've been looking at. So if we look at, let's say, for example, CL1 to CL2. No, that's CL1, CL6. Let's go. So this is CL1, CL2. So this is the two front contracts. And what you guys can see here, these are the two individual prices here on the top. And on the bottom, you see the spread. And what you can see, they got up to $1.61, currently trading as we speak at $1.51. This is very, very high. This is a very, very high level of backwardation. So the front end of the curve, longer, sort of higher than the going down the curve, and this indicates extreme tightness in the market. If we also look a little further out, we've got CL1, so the front contract, and 6 months out. So in this case, I think it's July contract. So again, that spread here is at $5.69. And what you can see in both of these spreads here is that that's really kind of rocketed in the last few days. And you've got to ask yourself why. Probably there's a few reasons here. The stocks at the Cushing supply hub in Oklahoma are at pretty low levels, down to about 21 million barrels, I think, which is historically very low. But probably more importantly is this idea that the outgoing Biden administration has just just put on a lot of sanctions onto oil tankers, insurers, et cetera, et cetera. And that's creating a lot of uncertainty in the market. And so there's been some sort of scrambling looking for supplies. And that uncertainty is causing the very front of the curve to trade at a premium, as we're seeing here. But if we go back in time a little bit, I mean, this is pretty high. So if we go back to the CL1, CL2, and we take it back, let's say a year, it'll probably take a while as a second here to load, but we're going to go back a year rather than a month. Let's just wait for this to load up. What we can see is that where we are at the moment at 151, so this is going back a year, you can see that for sure, it can go up to these prices, but we're at pretty high sort of levels. This is very elevated. The normal, I mean, the typical sort of level, you can see here just going back a year, even just on the right here on the distribution range, you see the standard deviations here that we're well out. I think we're into the third standard deviation away from sort of the normal, so to speak. So you see here, let's see the median standard deviation. Yeah, so from the mean going back a year, we're 2.75 standard deviations away from the mean. So that could be interesting if we get some sign of relief in the market, because what a lot of market commentators are saying is that, yes, it's a bit tricky, it's annoying for the Russians and the Indians and the Chinese refiners, but the reality is they will probably find a workaround, and the actual real quantity of oil physically removed from the market because of these Biden sanctions will probably be not that much. So yes, at the last few days, we've had a bit of a spike in terms of the curve, but we could see that coming off. And for those of you interested in that, I mean, I think if we look at the chart and see any kinds of signs of stabilization, that could be an interesting one. But just looking at the curve, just where I've got the actual curve, you see here, this is the actual oil price curve, the outright price here, and you can see it's very, very strong backwardation here. The front of the curve really, pushing up. And if we go back, let's say a day, let's have a look. Well, not a huge amount, but let's say if we go back a week, you can see there, and then we go back a month. Yeah, so you really see that. So not so much from a day ago, so we'll get rid of that one. But this is where so we're seeing, there we go. So you see this is where we're trading now. So you see the curve, not only the price here on the right-hand side has gone up a lot, but you see how the curve has really flipped very aggressively into sort of strength at the front. And you can see just what, compared to a week ago, which is the orange, and then from a month ago, you can see that all the additional price action is really at the very front of the curve here. You see down below here that, $5, $6, $7, $8 has all been added at the curve. So very strong for oil. So you want to be a little bit careful shorting it. I mean, I'm looking myself at that chart, which is here. But the reality is that it's still strong. So I'm looking at the curves, a little bit of weakness today. I mean, maybe weakness is a strong word, because there's been reports that Israel and Hamas are very, very close to a ceasefire. Thank God, finally in Gaza. But, and some people are saying that's causing just a little bit of weakness in the oil market. But the point is that conflict, horrible though it may have been for both sides on a humanitarian basis, did not really interrupt the supply of oil. So really we have to be looking at the situation with the sanctions on Russian oil exports rather than what's happening in Gaza. So I'm not totally convinced that this indicates weakness in the oil. I think probably I just want to see this maybe just sort of tire itself out a little bit more. Let's just have a look here. I mean, if you look at the moving averages here, we're still very much in a sort of a bullish phase. Not exactly seeing any signs of exhaustion yet, but that's something I think, maybe if it pushes up a little bit further to 80.22, like another dollar or two, we might see just a little sign of a stalling out, and then it could be time to short oil, and maybe even the time spreads, as I say. The other thing, just want to have a look at, we had overnight the speech of Himino from the deputy of the Bank of Japan. He essentially said, and we'll look at here the USD JPY. Again, you can see here that the USD recovered a little bit, and that's because I was looking at his comments last night at 8:30 when the speech came down. essentially said that, yeah, there could be a case for hiking rates if the data cooperates. And then he sort of hedged it by saying the data seems to be cooperating, but we don't have more information and it's difficult. There was even a headline saying that it was difficult. He said, difficult for the market to ascribe 100% probability either way of hiking or not hiking. So I think what's happened is that the market looked at that and said it was definitely not a clear message about the BOJ hiking towards the end of this month at their next meeting. So, the market's still pricing more or less 50%. But having said that, I haven't looked this morning yet. So that's going to be quite interesting just to see what the market is pricing in for Japan. Because remember, yesterday they were pricing in just 12 basis points. Okay, so it's interesting now the pricing in 15 basis points. So another 3 basis points. So it's gone up from 50% to about 60% of a hike at the BOJ on the 24th of July. But as we can see in the USD JPY, you can see that, it hasn't really done much. It's not as though the US dollar has collapsed on that. So the market is still probably on the balance of risk, really looking more at the PPI today and the CPI, of course, tomorrow is going to be the big one. Apart from that, guys, I won't keep it too long because we do have the data coming up. Gold, looking at just sort of pausing here, just as I say, we have real yields, still very strong. We have the dollar showing no particular signs of weakness here. We just have a look at the dollar. Yeah, you see the dollar still doing very well. This is a very, very bullish chart. What I would say overnight is that if you look at, for example, Australia here, up 27 basis points on the futures, New Zealand dollar up 58 basis points on the futures, CAD up a little bit as well. Basically just on that risk on tone with the fact that, there's this idea that maybe the Trump administration will not be as aggressive on day one with the tariffs. That has caused a little bit of a risk on kind of tone, in the risk assets like equities and some of these risk on sort of currencies here. We see even the euro up 39 basis points. So not a huge amount, but the point is that could be very quickly reversed if we get a strong PPI today and certainly a CPI tomorrow. That's really what the market's looking at. And then, of course, we have retail sales to give us later in the week to give us a bit more of a sense of what's happening with the US consumer. But then we have this new gentleman in the White House from next Monday. So probably we're going to be in a holding pattern after CPI. The market will digest that, and then we'll have to turn our attention to Trump. One other thing I just want to have a quick look at here, guys, is just on the butterfly. I talked about it earlier. I just want to show you that chart here. If we look here at the 2s, 5s, 30s. So what this chart is showing us here, as you see here on the top left, this is basically long the 2-year and long the 30, so long on these wings, but shorting here, see minus 2 times or twice the 5-year. So essentially this is a chart which shows us the relative performance of the yields of the curve, so a butterfly. So essentially this one is basically saying that the front end, the 2-year, is relatively anchored, and the 30-year is, maybe not anchored, but really the pain here is being taken by the 5-year. And you see here on Friday, this big red candle. This is really showing us here the underperformance of the 5-year bond. So I'm going to be looking at this today on the PPI if it's hot, because I expect that if that happens, the pain will be taken really by that 5 to 7-year part of the belly. Because as I said, if we look at, let's say the 2-year yield, can that go up a little bit more? Sure. I think it could go up to maybe this level here, 451, 452, 453. But I think that's about it, because at that point, you're essentially pricing out all cuts for 2000, the next sort of 12 to 16 months. And you've got to say that's maybe enough. Where there could be a little bit more pain for sure is the 30-year. But as you guys can see, that's already gone a long way. I've got a buy zone here. If it gets up to, sort of somewhere up here, I do believe that you see here, there's got to be resistance around about, 5.15, 5.2, 5.1, somewhere up there. That does become quite interesting for real money players like pension funds and all these kind of people here, because you also at that point, probably the real yields will be at a point where we're up 2.6, 2.7 real yields, which starts to give you quite a juicy return. Okay, I'll leave it there, guys. Have a great day, and we shall be talking again, no doubt, tomorrow. Thank you and good luck.